Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Across 54 nations and more than 1.4 billion people, Africa's financial sector has become one of the most consequential growth stories in emerging markets. From the boardrooms of Santon to the trading floors of Lagos and Casablanca, the institutions that move capital, underwrite risk, and connect savers with borrowers are quietly reshaping the continent's economic trajectory. This presentation takes you through the full structure of the financial sector and every one of its sub-industries, with a particular focus on the multi-billion-dollar companies that anchor each segment and the structural forces that will determine their next decade of growth. The financial sector across the continent now commands more than $240 billion United States dollars in assets held by listed institutions alone, and consistently represents between 18 and 22% of weighting in the major equity indices from Johannesburg to Lagos to Cairo. The population served exceeds 1.4 billion people spread across 54 distinct markets. Perhaps the most telling statistic is financial inclusion. Roughly 25% of African adults now hold a formal bank account, more than double the 11% recorded by the World Bank Global Findex in 2014. This expansion is the single most powerful structural tailwind behind the entire sector. The financial sector across Africa is organized along three principal pillars. The first is banks, by far the largest pillar, encompassing diversified megabanks and regional lenders. The second is diversified financial services, which spans consumer finance, capital markets, financial exchanges, mortgage real estate investment trusts, asset management and custody, insurance brokerage, and multi-sector holdings. The third pillar is insurance, broken into life and health, multi-line, property and casualty, and reinsurance. Each of these sub-industries operates under different regulatory regimes, serves different customer segments, and produces very different return profiles. Understanding the sector therefore means understanding each sub-industry on its own terms. When ranked by market capitalization, the largest listed financial institutions reveal the geographic concentration of the sector. Standard Bank Group and FirstRand together command more than $50 billion United States dollars in market value on the Johannesburg Stock Exchange. Sanlam and Old Mutual anchor the insurance segment from Cape Town. Adagera Wafa Bank represents North African banking power from Casablanca. Commercial International Bank, Capitec, and Zenith Bank round out the list, illustrating how South Africa, Morocco, Egypt, and Nigeria between them host the overwhelming majority of the continent's listed financial heavyweight firms. Outside these four markets, listed financial sector depth remains modest. 5 structural forces are compounding across the decade. First, a median age of 19 years means Africa will continue to add tens of millions of new banking, insurance, and investment customers every year. Second, the mobile money revolution, with more than 600 million registered accounts, has rewritten the unit economics of serving low-balance customers. Third, the African Continental Free Trade Area is creating a single market of 1.3 billion people, unlocking cross-border flows in payments, banking, insurance, and capital. Fourth, pension reforms in Nigeria, Kenya, Ghana, and Egypt are deepening funded retirement systems and channeling long-term domestic capital into local capital markets. Fifth, post-restructuring clarity in Ghana, Zambia, and Ethiopia is gradually restoring investor confidence in banking sector balance sheets. The opportunity set is vast. Roughly 75% of African adults remain unbanked or underbanked. The small and medium enterprise credit gap exceeds 400 billion United States dollars per the International Finance Corporation, and climate finance flows are projected to exceed $100 billion annually by 2030. Cross-border payment interoperability under the Pan-African Payment and Settlement System is dismantling historical friction. On the risk side, currency depreciation in Nigeria, Egypt, and Angola has eroded dollar earnings and inflated non-performing loans. Sovereign exposures remain elevated across several banking systems, inflation pressures net interest margins, political instability disrupts operations in the Sahel and Horn, and regulatory tightening on capital, liquidity, and climate disclosure continues to raise compliance costs. Although the sector spans 54 markets, activity is heavily concentrated in 4 hubs. South Africa alone accounts for more than half of total listed financial market capitalization, anchored by Standard Bank, FirstRand, Sanlam, Old Mutual and Santam. Nigeria follows, with Lagos-listed banks and insurers representing the largest financial pool in West Africa. Egypt dominates North Africa east of Morocco, with Commercial International Bank and the National Bank of Egypt as anchors. Morocco, through Attijari Wafa, Bank of Africa and Sanlam's regional operations, extends its influence across Francophone West and Central Africa. Kenya, while smaller in absolute terms, is the most sophisticated hub in East Africa and a testbed for digital finance innovation. This sector overview is one of 17 videos in the series. The companion videos examine banks as a whole, then diversified banks and regional banks in turn. The diversified financial services pillar is broken into consumer finance, capital markets, financial exchanges and data, mortgage real estate investment trusts, asset management and custody banks, insurance brokers, and multi-sector holdings. The insurance pillar is broken into insurance as a whole, life and health insurance, multi-line insurance, property and casualty insurance, and reinsurance. Each video stands alone but also builds on the framework laid out here. Together, the series gives a complete map of the African financials landscape. 5 investment themes cut across every sub-industry. Scale and consolidation. Subscale institutions will be acquired or marginalized, with continued merger activity across Nigerian, Kenyan, and North African banks and insurers. Digital first. Digital-only subsidiaries and neobank partnerships will determine which incumbents capture the next 100 million customers. Sustainability-linked lending. Green bonds, sustainability-linked loans, and climate risk underwriting will become a defining product set within 5 years. Cross-border payments. Pan-African real-time payment rails will compress correspondent banking fees and unlock trade finance for small and medium enterprises. Currency hedging. Institutions that offer credible local currency hedging products will earn outsized fee income in volatile foreign exchange environments. In summary, the African financial sector is on track to exceed $350 billion in listed assets by 2028. Digital banking and embedded finance will redefine competitive positioning across every sub-industry. Cross-border consolidation under the African Continental Free Trade Area will accelerate over the next 5 years. And climate finance will emerge as the next major asset class for African institutions. The companies that navigate currency volatility, regulatory tightening, and technological disruption, while maintaining capital discipline, will be the multi-billion-dollar winners of the coming decade. Thank you for watching this overview of the financial sector.